Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KLA Corporation Quarterly Report. KLA Corporation offers a wide range of businesses and services that cater to the semiconductor and related electronics industries worldwide. The company operates through three main segments: semiconductor process control, specialty semiconductor process, and PCB and component inspection. Under these segments, KLA Corporation provides various solutions including inspection and review tools, metrology systems, chemical process control equipment, wired and wireless sensor wafers and reticles, wafer defect inspection, review and metrology systems, reticle inspection and metrology systems, and semiconductor software solutions. These solutions enable customers to identify defects, measure pattern dimensions, film thickness, and other properties of wafers. In addition to these services, KLA Corporation also offers etch, plasma dicing, deposition, and other wafer processing technologies for the semiconductor and microelectronics industry. The company's solutions are designed to accelerate yield learning rates, reduce production risk, and improve quality control in advanced and traditional semiconductor packaging markets. Furthermore, KLA Corporation provides direct imaging, inspection, optical shaping, inkjet and additive printing, and computer-aided manufacturing and engineering solutions for the PCB market. These services enable customers to improve their manufacturing processes and increase productivity. Overall, KLA Corporation's diverse range of businesses and services make it a leading provider in the semiconductor and related electronics industries worldwide. KLA Corporation's stock price has skyrocketed by over 79.28% in the past year due to a combination of factors. The company's strong financial performance has been a significant contributor, with record revenue and earnings per share growth in fiscal year 2025. KLA consistently surpassed its revenue and EPS forecasts throughout the year, with revenue increasing by 17% to $12.745 billion and EPS growing 29% year-over-year. The demand for artificial intelligence, AI, and high-performance computing, HPC, has also played a major role in driving up KLA's stock price. As a crucial enabler of the AI ecosystem, KLA benefits significantly from the expansion of AI infrastructure across various sectors. The company's dominance in process control, with a 56% market share, further solidifies its leadership position. The global semiconductor market is experiencing robust growth, with global sales of semiconductor equipment projected to increase by 7.4% to $125.5 billion in 2025. This growth, combined with the increasing relevance of process control at the leading edge for foundry/logic and memory, has contributed to KLA's success. In addition to its financial performance and market dominance, KLA's revenue from advanced packaging is projected to exceed $925 million in 2025, a notable increase from $500 million in 2024. Analysts have also maintained buy ratings for KLA shares and increased their price targets, indicating strong confidence in the company's future performance. Strategic industry developments, such as new deals and potential partnerships, have further contributed to KLA's stock price surge. The combination of these factors has propelled KLA Corporation's stock price to a significant increase of over 79.28% in the past year. KLA Corporation market capitalization of $175 billion is significantly larger than the average industry peer of roughly $8 billion. This shows that KLA Corporation holds a significant advantage in their industry. KLA Corporation trades at a lower price-to-earnings ratio of 39 times and a higher price-to-book ratio of 31.95 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 71% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. Revenue growth is primarily driven by an increase in service revenues, particularly from the installed base of tools. This is evident in the strong customer adoption of advanced packaging portfolio products and higher investments by memory customers. Additionally, revenue from memory customers in the semiconductor process control segment has also contributed significantly to revenue growth. Furthermore, service revenues from an increasing number of tools in the installed base have also played a crucial role. On the other hand, revenue decline is primarily driven by lower volume of products sold, particularly to customers in China in the specialty semiconductor process segment. The exit of display business in the PCB and component inspection segment has also contributed to revenue decline. Moreover, decrease in specialty semiconductor process revenues and PCB and component inspection revenues have further exacerbated the decline. External factors such as U.S. export restrictions on semiconductors and semiconductor technology to China and disruption of global operations due to trade restrictions imposed by governments have also had a significant impact on revenue decline. The net income and profit margins of a company have undergone significant changes over the past year. On a quarterly basis, net income increased by 39.1% from $824,527 to $1,145,682, while on a yearly basis, it rose by 28.2% from $1,770,378 to $2,266,722. This substantial increase in net income is also reflected in the company's profit margins. The net income margin has improved significantly, rising from 27.2% to 34.7% on a quarterly basis, and from 30% to 34.8% on a yearly basis. The gross margin has also seen an increase, rising from 60.3% to 61.6%. These changes in profit margins are likely due to various factors such as changes in revenue, cost of goods sold, or operating expenses. The exact reason for the change in profit margins is not explicitly stated in most pages, leaving room for speculation and further analysis. However, it is clear that the company has experienced a significant improvement in its financial performance over the past year, with net income and profit margins showing substantial increases. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided data, the net cash provided by operating activities for the 3 months and 6 months ended December 31, 2025, were $2.529 billion and $2.53 billion respectively. This significant increase from the previous year's figures of $1.844 billion and $1.85 billion demonstrates a substantial improvement in the company's ability to generate cash from its core operations. The consistent growth in operating cash flow suggests that the company is effectively managing its resources, reducing costs, and increasing revenue, ultimately leading to a positive operating cash flow. The company's financial performance reveals a notable decrease in interest expenses over the past year. According to the extracted summaries, interest expense decreased by $5,313 from 2024 to 2025, with a significant drop of 10% when comparing the 6 months ended December 31, 2025 to 2024. This reduction is evident across various periods, including the 3 and 6 months ended in 2025. In contrast, the company's debt level has remained relatively stable over the same period. Despite an initial decrease in total financial liabilities by $8,219, the overall debt level has fluctuated slightly, but not significantly. The total debt financial liabilities decreased from $0 to minus $28,615, and subsequent reports show no significant change in debt levels. The company's interest expenses have undergone a substantial reduction, while its debt level has remained relatively stable. This suggests that the company is effectively managing its financial obligations and reducing its interest burden. The performance of various segments and regions within the company has been mixed. On a positive note, specialty process control and semiconductor process control have shown significant growth, with revenue increases of $3 billion and 9% respectively. Additionally, PCB and component inspection has experienced a 14% revenue growth in the 6 months ended December 31, 2025. In terms of regions, China, North America, Korea, and Taiwan have all demonstrated growth, with revenue increases ranging from 12% to 35%. However, some regions have underperformed. Taiwan's revenue decline has slowed down, but it still experienced a decrease in revenue from 25.6% to 22.7%. Korea's revenue also declined from 14.5% to 10.1%. The other segment and China region have performed poorly, with no specific information provided for the former. The company will need to address these underperforming areas to achieve overall growth and success. Management is optimistic about the company's outlook, citing significant market expansion and diversification in the semiconductor industry. They attribute this growth to the increasing demand driven by artificial intelligence, AI, innovation. The company's portfolio of products is well positioned to support leading-edge demand, particularly in memory and foundry/logic markets. The management expects Asia to continue being a major revenue generator for the company, with total revenues increasing 7% in Q2 FY26 compared to Q2 FY25. They are making substantial investments in process control to meet the growing demand, which is driving strong growth in Korea, North America, and Taiwan. To maintain a competitive advantage, management emphasizes the need for continued investment in research and development, R&D. They remain committed to product development in new and emerging technologies. Additionally, they expect to be in compliance with financial covenants at the end of their fiscal year, ending June 30, 2026, with sufficient liquidity to meet requirements for at least the next 12 months. However, management also acknowledges potential risks, including ongoing trade restrictions that may harm the company's business. They are taking steps to mitigate these risks by obtaining required licenses and applying for export licenses to avoid disruption. The company has demonstrated its commitment to returning value to shareholders through various means. One key aspect is the payment of dividends, which has been consistently practiced. For instance, in the 3 months ended December 31, 2025, the company paid out $249.7 million in regular, quarterly cash dividends and dividend equivalents. In addition to paying dividends, the company has also engaged in share repurchases. This strategy allows the company to reduce its outstanding share count, thereby increasing earnings per share for existing shareholders. The company's multiple pages confirm that it has indeed bought back shares, with notable examples including 1,083,000 shares repurchased at a total cost of $1,101,953,000. These actions collectively demonstrate the company's dedication to rewarding its shareholders and enhancing their returns on investment. By paying dividends and buying back shares, the company is able to provide value to its investors while also aligning with its long-term goals and objectives. There are concerns about inventory buildup or supply chain disruption. The data suggests that inventories have increased significantly over the past 6 months, with a rise of $69.7 million from June 30 to December 31. This increase in inventory levels raises questions about whether companies are stockpiling too much product, potentially leading to waste and decreased sales. Furthermore, there is also a risk of supply chain disruption due to significant purchase commitments totaling approximately $2.75 billion as of December 31. If these deliveries are delayed or canceled, it could lead to earnings volatility and increased risk of inventory-related charges. Additionally, export license issues may impact product shipment and supply chain, exacerbating the problem. The situation is further complicated by the potential for inventory write-offs due to end-of-life parts purchases. Companies that purchase large quantities of discontinued parts may face significant expenditures on inventory that will eventually become obsolete. This could lead to a substantial financial burden and decreased profitability. Overall, these factors suggest that there are legitimate concerns about inventory buildup or supply chain disruption. That concludes the financial summary for KLA Corporation. Feel free to comment below, and I will be happy to answer them when possible.